Hey everyone, I wanted to show you just kind of behind the scenes how a financial plan gets created. A lot of times when we hear financial planning, it's just a lot of ambiguity around it. And I really haven't seen anyone put together a kind of tutorial video of how these plans get built. And different advisors have different processes. I have my own process. There's things that I focus on that maybe others don't. But overall, when you're looking at building a plan, there's some core pieces that go into it. And the most important part is starting with, where we are and where we're going. That's a lot like driving from New York to California. You can hop in the car and just start driving west and you'll eventually get there. Having a financial plan and having an advisor who has the experience and the tools to help you get there is like installing a GPS into that car so that when you're getting from New York to California, you know which routes to take. You know if there's something that comes up, how to get you rerouted to your destination. And then finally, having a destination in mind is important and knowing what that will look like and where you're going, because that could change as well. So I have a dummy account that I set up. These are not real clients, but it is based on, similar real life situations that clients that I've worked with and situations I've dealt with. So this is just a standard couple here, Peter and Paula Professor. Now, imagine they came on board and we had a nice introduction meeting, explaining some of the services. And they said, you know what, Mark, I'm looking to be kind of an ongoing client, have a plan built out, have ongoing management and financial planning. What would that look like? And where would that start? Your net worth, we're going to plug in everything, of course, the basics, your bank accounts. Here we can link up bank accounts so that they automatically feed in. But in this case, since it's a fake client, I just put in 80,000. If they have credit card debt, I would link up their credit card so that we're seeing any type of debt and if that's increasing, decreasing based on the plan that we have in hand. Next, we start with the investments and we start to plug in and connect up all the accounts. So these can be from your 401k. This can be from your personal accounts. This can be 529 accounts, you name it. We link it up and so that everything shows together all at once and we can keep track of everything. If there are any stock plans, any loans, we put that in. Property, this couple owns a home, so that's here. They don't have a mortgage on it, so that's why there's no loan. And then if there's any insurance or businesses they own, that goes in there as well. Now, when we start to plan, most times when people think of financial advisors, think all they do is manage money. And, that's true. Most of the advisors out there, that's all they do is just investment management. When you're coming to someone who's focused on financial planning, this always starts at the goals of where you want things to go. How do you want your life to look? Either in retirement or semi-retirement or early retirement or taking sabbaticals, right? There's so many different variations of it that mapping out different what-if scenarios is a huge, huge part of what I do. So for this couple, I had them both retiring at 67. They're both age 55 right now. We put in, hey, they want to spend $7,000 in retirement. We put in their annual retirement health costs here, their long-term care, depending on where they want to go. There's lots of options that we can look at there and planning wise. Now, some of the other things we'll tie in or just some of the other basics like your income streams, any savings that are going on, any expenses that you currently have. And finally, we put it all together in this blueprint so that it's a clear as day chart showing where things are, how they're held and titled. Now, once we have all that and we worked on it, talking together as to where we want things to go, what are the biggest priorities, that will drive where we head to next. But for this couple, let's say that their big thing is retirement, they're 55. And maybe they want to maximize what they're doing. They want to set themselves up best they can for retirement. Well, there's a lot of different factors that go into that. Not only at the time when to take Social Security, you also have to think about things like Medicare, what options you would have then. You'd have to think about the cash flows and how we're going to fund retirement, once the income stops. What strategies will we use? Will we use some accounts first? Will we use others first? Will we pull from all three at the same time? In this case, there isn't. Or an annuity that they had bought into. When we look at that and we tie it all together, essentially we're going to have a current plan here on the right side. Or if they didn't do anything, this is where, they would end up with 6.5 million, based on the Monte Carlo simulation that's being run, and where most trials end up out of those 1,000 trials that are being run. Now, all the levers that we can pull down here, and there's a lot more than this, but these are just the simple ones that we can tackle. First are things like the tax strategy. So first I would start off here and just put everything to match the current plan, as if they never met me. Then I start to work on things like, well, what about their tax strategy? They had a bunch of pre-tax money. What if we did Roth conversions, and what would that do? So first I head over here to tax planning. Here we'll show you their current plan. If they did nothing, you can see here they're in the 22% tax bracket up until retirement. They then fall into the 10, 12%. But RMDs required minimum distribution start, and at 75, bumps them back into the same tax bracket as when they were working. And then eventually they start to go up even higher into the 24% tax bracket. That due to those RMDs and increased costs later on. So I would go in here, we would look at a number of things, but just for the sake of time here, I want to show you just quickly what this strategy shows. So here we have top strategy is using the 22% tax bracket for Roth conversions and using a withdrawal strategy of using your taxable accounts first, then the tax deferred, and then those tax-free accounts like the Roths. So down here, I'm going to make those adjustments. I'm going to choose taxable, tax deferred, tax-free. I'm going to use the 22% tax bracket and a conversion rate using the ordinary income tax bracket of 22. And let's see what that does to the plan. So here we can see, let me just refresh. Yeah, so here we have a significant amount of savings in terms of doing those Roth conversions throughout their lifetime and adding a lot of money to their ending balance based on the Monte Carlo. But if we look at the proposed plan now, here we go. All right, so here we are. We have a savings of $2 million of taxes paid by using up the 22% tax bracket. So now I go back here into my retirement plan. I'm going to add that strategy in now and see what happens. So here I'll go to current strategy, that everything matches. And you can see these numbers should add up to the same number here once everything refreshes. So now I'm going to turn on the Roth conversion strategy. And let's see what that does. Okay. Well, we've added quite a bit of ending value to their balance, and almost $1 million, which is pretty significant, for this couple. Now, the next thing I would look at is they're 55. They're not at Social Security age yet, but what would their Social Security strategy look like? I'm going to choose the optimal strategy, and I'll show you what that is in just a moment. But I'm going to compare it to the current strategy, which is just pulling at full retirement age, which is 67 for them. What you can see here is that if we use the optimal strategy here, which is Peter applies at 70, Paula applies at 70, we have an increased amount of total benefits received from the Social Security. That's a little over $600,000 more that they would get if they lived to their full lifetime, in this case, 95 years old. Now, when we look at Social Security, there are many different strategies to look at. This is just showing one based on their expected lifetime, but there's a whole bunch of other strategies you can use if they don't feel they're going to make it to 95 and they want to hedge against that. But let's go ahead and add this in now to the plan. So I'm going to go back here. I'm going to turn on the Social Security to the optimal strategy, and boom, let's see what happens here. Okay. Yeah. Now we've added 1.1 million. The next thing I'd look at is this asset allocation. So what you'll see here is if we go to investment, I just plugged in as a general moderate portfolio that they're in, 60/40. In real life, they would have actual securities that are moving, throughout the day in the market. So it won't be perfectly 60/40, probably, but this would just show where they are currently. And here, the first thing I would do when it comes to investments is we choose a benchmark. A benchmark, there's the S&P 500, there's the Dow, there's the NASDAQ, there's thousands of different indices out there. And depending on the client situation, I would look at everything and come together with a benchmark that I feel is appropriate for them. And now our job is to get that benchmark and align our portfolio with that benchmark. So what I would do first, let's say we do a risk tolerance assessment. I look at how much growth they need, and we come up with the conclusion that they would be they only want, all equities based on they've been very aggressive. They can handle volatility in the market. 50% decline is really not a big deal for them. They've had a lot of experience investing in the market. And so here, let's say, for example, we choose an MSCI World Index benchmark. Well, here, you can see is 100% equities, of which almost 70% is US and almost 30% is international. So what I would do from here is then go back to the retirement analysis, and I would change their allocation now and say, okay, what if we move to our benchmark of the MSCI World Index? What will that do to their plan next? Wow, significant difference. And why the significant difference? Well, they're so young. They're 55 years old. They have 40 years to invest. And compounding returns, getting out of a 60/40 and going into an all equity strategy for this couple, it will more volatility. That's why these few changes here, just looking at the allocation, looking at Social Security strategy and the tax planning, you already have a humongous difference based on where they started and where they are. Now, this is just a quick snapshot of this couple. Depending on your situation, things can be completely different and variables may change, but these are the first big ticket items I look at when building a plan. So if this sounds like something you'd be interested in, check out my site, schedule a call. Every first introduction call is complimentary, and I get to know you a little bit more about your situation, and you get to know a little bit more how I work with people. So this sounds good. I look forward to speaking with you. Bye-bye.